Hi, I'm Calvin Rose, and welcome to Invest Smarter. Several years ago, I was asked to join a chat group on Facebook called Friends of Vanguard. And maybe several months to a year or so after that, they decided to form this group called Friends of Vanguard. It's a Facebook group, private group. And for some reason, they asked me to join. I guess maybe I had some color to it. Who knows? But anyway, I decided to do a video because I on this group, I keep hearing people debating whether they like the Vanguard S&P 500 funds and ETFs, or if they, do they like the total stock market ETF. So I decided to take a look at these Vanguard funds and see how they compared to some of the other index funds available in the markets. So anyway, let's dive into it and take a look and see how Vanguard performs compared to the S&P 500 Total Return Index, and how it performs compared to some of the other index funds out there. Now, before I get into the video, please understand that these results that I'm going to show you look back over a 15-year period, and they most likely won't represent what's going to happen over the next 15 years, but I think it's kind of instructional or eye-opening to take a look and see how some of these funds have performed in the past. Again, it doesn't mean they'll perform this way going forward, but I think this is an interesting look. So the first thing I'm going to do here is we'll take a look at the funds that I chose to look at, all sort of plotted on each other. And you can see it looks like somebody took a squirt gun with paint in it and squirted it at the graph. But what's in this mess here? Well, we've got the S&P 500 Total Return Index. That index includes reinvestment of dividends. We have the T. Rowe Price S&P 500 fund, PREIX. I'm assuming this is a mutual fund. The nationwide S&P 500 fund, NSPI, which used to be called GRMAX. And then there's the one that most of you have heard about, the SPY SPY ETF. Then there's iShares IVV. Then we have the Vanguard Total Stock Market ETF, VTI. And that's not really an S&P 500 index fund, but I wanted to throw it in here to see how it performed relative to the S&P 500 index and relative to some of these other S&P 500 funds. Then we have the Schwab S&P 500 index fund, SWPPX. That's, again, a mutual fund. And then the Vanguard VOO, which is the S&P 500 index fund, also the mutual fund VFIAX. So those are all the funds here. And as you can see, you really have a kind of a difficult time telling most of them apart. So it's sort of hard to tell which ones are better, except you can clearly see this nationwide one falls below the other, so kind of stands out in a negative way. So let's look at this another way and see if maybe we can figure out, what some of the differences are. Well, if we plot these on visualize my portfolio plot, you don't really get much better. So you can see that all of the returns, so that if for those of you who haven't seen this axis, the y-axis, is the compound annual growth rate, or basically the average annual return that you would have gotten over the 15-year period prior to November 30th, 2021. What matters is that you cover a long enough period so that you have some good times and some bad times. So it's basically a good tell of how these funds might perform during good and bad times. So you can see here, these are all grouped together. You really can't see much of a difference in terms of return. And then on the x-axis, this is the maximum loss you would have incurred from the peak to the valley at some point in that 15-year period. Typically 2007 to 2009. That was the big crash where these funds, most of them dropped about 55%, as you can see here. So you really can't tell much from this graph. So let's take this graph and zoom in a little bit and see if we can see a little bit better here. Oh, okay. So now if we zoom way in, you can see clearly that here's the index. So this is what everybody's trying to target. And the Vanguard S&P 500 index does a really great job here. I mean, it's really literally almost right on top of the index. So, after fees and expenses and all that sort of stuff, it does a really credible job of matching the index. A really great job here. If you look at some of the other ones, the Schwab fund has a slightly less return, but also has a better loss characteristic. Again, we're not talking about much here. I mean, this ranges 0.5% in loss, so we're not talking about a lot. Now, if you look at the nationwide index fund, not only is it quite a bit less in terms of return here, but it's also almost 2%, a little over 2%. Additional loss. That's really not good. So you don't want to be that far out. But the rest of these are all pretty well grouped. If we look at SPY, this Spider's SPY ETF, again a little less return than the Vanguard VOO or VFIAX 500 index fund. About the same maximum loss. iShares IVV right in the group here, and then we've got T. Rowe Price, which has a little bit less return, a little bit more loss, but again, not a lot. And then the Vanguard Total Stock Market ETF, VTI, does a really great job in terms of return. So it beats all of these in terms of return, but has just a little bit more loss. But again, you're talking 0.5% here, a 0.5% range. So it really doesn't matter. So do these differences matter to you over the long term? Well, let's take a look at that and see how that might affect you. So now we're going to look at this a little bit differently. Now what I've done is I've taken each one of these funds and I've plotted the growth of a $100,000 initial investment back, 15 years prior to November 30th of 2021. And here's the amount you would have had you invested $100,000 in each one of these and let it sit there for 15 years without touching it. So clearly the Vanguard Total Stock Market ETF, VTI, the clear winner, you would have ended up with almost $449,000 in your portfolio after starting out with $100,000. Here's the next one, the sort of dark gray line is the S&P 500 Total Return Index. So that's really the benchmark that we're measuring these against. You would have ended up with almost $445,000. So, about $3,000 less, $3,000 or $4,000 less here. And then the Vanguard 500 Index Fund, you would have ended up with a little bit less than the index, but really this is not bad because remember that they've got to take some amount of fees out of here, so they've got to make some money somehow. But you really aren't that far off here. And then next in line is the Schwab SWPPX fund at $442,000. Finally, we have iShares IVV at $438,000. But notice that this is $10,000 less than the Vanguard Total Stock Market Fund. Now, again, the Total Stock Market Fund is not trying to match the S&P 500 Total Return Index. It's a slightly different animal, but I'm doing this comparison because I keep hearing people talk about the Vanguard Total Stock Market ETF on the Friends of Vanguard Facebook page. So I decided to take a look and see, is it really better? Well, yeah, it is a little bit better. And then we have SPY, the sort of standard, and here, at $438,000 after 15 years. So, about $6,000, $6,500 roughly less than the index over that time. Not a big game changer, but it is a difference. And then we get down to the T. Rowe Price, where you're really starting to fall off, $429,000 after 15 years. And finally, we have the Nationwide Fund, which looks like it's about $38,000 less than the index. So that's really not a fund you'd want to be in. I hope you enjoyed this little exercise. It's just a fun little exercise to see how these different funds all compare to each other. And look, if you'd like me to compare some other ETFs and funds, happy to do that. Please leave some suggestions in the comments below. My name's Calvin Rose. This is Invest Smarter, and thank you for watching. That's all for now.